begins to level off. So the Gini doesn't rise at the same rate that mean income does. That is, the level of development does. It's going to sound a little bit like there might be a Kuznets curve here. So we'll hang on to that doubt. Again, is the Philippines an exception to this rule, or is it bang on this rule? Where's the evidence that allows us to answer that question? I put it up there again. I wonder why I did that. Gee, I don't know. I think I've said everything I want to say about that. So here's an extension of the solid circles being these pre-industrial ancient economies, and then the empty circles being the modern economies. And you can see that downward drift in the Gini, the measured inequality, continues in the present day. Sweden, being very egalitarian and all that. African countries, Nigeria, and I guess that's, I don't know what that is. Tanzania, right? And what's the one above? That's the Congo, right? Congo above. Which would be most comparable, with the pre-industrial economies, ancient economies in the sample. We'll come back to some of that. Okay, so the extraction rate has got to be falling with economic development. And it sure does, right? So again, the filled-in circles are the ancient observations, and the empty ones are the more modern ones. And the dotted line summarizes that information. And it's clear the extraction rate is declining over 2 millennia. The drift, it drops quite dramatically in early times, and then begins to level off at some kind of equilibrium among the advanced economies, the richer advanced economies. Okay. The falling extraction rate holds where we're comparing the ancient with modern pre-industrial societies. It holds whether you're comparing simply the ancient and modern societies, whether they're pre-industrial or not. Well, I don't know. Do you think that's true or not? Well, I think so, but anyway. These Gini coefficients mean different things in different societies, now that we know a little bit about extraction ratios. Here are 3 propositions. While the estimates of the Ginis for the pre-industrial societies are roughly fall in the same range as the ancient ones, as we observe them today, the ancient inequality is much, much greater when it's expressed in terms of the relationship to the maximum feasible inequality. That is the extraction rate. The ancient societies were much better, or were less concerned about extracting surplus from the system than modern societies are. And I guess democracy and voice is playing a role. Proposition 2, under conditions of economic growth in poor and middle income countries, if you have constant inequality, it reflects a lot of restraint on the elite, who could, of course, with growth, raise their own surplus. I think there's some morals there. Third, there is a Kuznets curve out there. More on that in a second. And there it is. So there's 2 millennia. There's variance and there's other things at work. But when Simon Kuznets was offering, I guess that paper in 1955, AER reaches the top 10 on hits. So Simon should be proud of that. But what you get a Nobel Prize for is not whether you're right. It's whether you're clever. That's what you get the Nobel Prize for. And Simon was certainly clever. And his notion was you had to have an industrial revolution to do it. An industrial revolution would create all these inequalities, which might even be essential to have the accumulation for miraculous growth, but will give you the inequalities, and then you reach a peak and you drop down the other side. So that thesis went, and that thesis has been out there for 50 years, and people still lean on that thesis, especially if they want to justify rising inequality in poor societies. We've got to have the rising inequality to get the accumulation and the incentives to get the double-digit growth rates and so on and so forth. There's no evidence in this data that Simon's characterization of experience after the Industrial Revolution is true. But you still find a Kuznets curve. But you have to go way back to Rome and bring it up to the present to see in the long run this Kuznets curve in the data. So that strikes me as a little interesting. Next issue is, what about the top 1% in this story? I mean, you're talking about Gini coefficients and all that stuff. What about the top 1%? Why am I interested in that? Well, Tony Atkinson and Thomas Piketty and a whole train of people have been using tax information to construct inequality measures based on the income accruing to the top 1, 2, 5% in societies. And they've done this for all the European offshoots, all the way across the 20th century. So the question is, was this true of ancient societies as well? That is, that there's this very strong correlation they find, looking at 20th century evidence, between the share of income accruing to the guys at the top 1%, and overall inequality. If that's true, great, because it's much easier to construct the share of the top 1% than to fill in everything else, or all the folks below that. So that would be nice. We'd make some progress in getting more data. Problem is, they're not really true distributions because we're looking at social classes, right? And furthermore, to estimate the top share in our data set, you have to assume that the top group obeys a Pareto distribution. Well, big deal. Big deal. That's what Atkinson does for his data, so why can't we do it for ours? And so we do. So there. And that's what you get for a limited sample. These numbers for the top 1% share are huge. The year 1000 for Byzantium, almost 1/3 of income is accruing to the top 1%. And drop it down through the rest of this group. And then look at the more modern examples. The US, a very unequal nation with a very large share of income accruing to those at the top, with, I must say, political implications. But those numbers are well below the ancient inequality numbers. So what happens when you plot where you have both, where you have the evidence for both? That is, you have overall measure of inequality based on the social tables and the top 1%, and there is no significant correlation in that data at all. The Atkinson result may be true of the 20th century. It wasn't true of all the other centuries before that. So what is correlated with it? Well, here's a third proposition, and that is, didn't we just do that? Okay. It's everything below that top share that matters. the economic distance between average per capita income and the peasant at the bottom. The economic distance between the average income for the elite at the top and the peasant at the bottom. Those are the things that might matter. Let us see. So we've got average income Y. We've got the wages of the poor, W. Let's look at that ratio and see how that correlates with the inequality measures. Not only will this tell us something about what's pushing inequality in these systems, but it also might invite another shortcut to try to get data. If you find out that this simple measure of per capita income relative to income at the bottom is a very good predictor of overall inequality, you can find that data, Y and W, for a lot of countries for which you can't get the inequality data. So that might be helpful too. It might also be true, if that works, why not look just at the rent-wage ratio? That might be a good indicator for these pre-industrial societies of inequality. Anyway, that's what it looks like. Very strong positive correlation between that ratio of average income economy-wide and the income of those at the bottom of the distribution versus the overall measure of inequality. So it does very well, this simple index, in predicting inequality for these pre-industrial societies. It's not going to do very well for very sophisticated economies where the distribution of human capital and the wage structure really matters a lot. But it'll do well for these less sophisticated societies, it appears. Okay, well, some of you in the room may be used to doing empirical work where you have micro-observations adding up to 10,000 or something. I don't. I deal with much smaller data sets, like 27. But let's see what happens when you just run some simple regressions on the economies you've seen. First off, are you a colony? If you are, it's going to create a hell of a lot of inequality in this database by 13 or 14 points, 15 maybe, in changing the size of the Gini, raising the Gini coefficient. That probably doesn't surprise you that colonists come in and extract surplus better than the elite does who were there previously. But the numbers are big in explaining the variance across these societies. Next, up above, you get the Kuznets curve. That is, as economic development takes place and GDI per capita goes up, so doesn't the Gini coefficient. However, it goes up less and less over time because that second term, that square term, is negative. So it begins to turn down. You get the Kuznets curve in it. That's pretty cool. You get the standard World Bank result, which is urban societies are more unequal than rural societies. You get that in this data too, so that's good. Then you get this result for population density. Increase of population density lowers inequality. Wait a minute. Increase in population density lowers inequality. That doesn't make much intuitive sense, does it? And in a pre-industrial society, you increase the pressure of labor on land. That should increase rents for the landlords and lower wages for the landless peasants, shouldn't it? And that would create greater inequality. And you get the opposite result in this data. What the hell is going on here, folks? Well, my explanation of this is this, that that argument may be true, but it's also true in densely populated societies. The price of the key wage good, grain, whether it's rice, wheat, or whatever, the price of grain is very high in those societies where the land-labor ratio is low and the labor-land ratio are high.